from around the world. My name is Bob Weissman, and today, welcome to the webinar featuring Mark Minervini, one of America's most successful stock traders, as you all know, U.S. investing champion with his returns as he was featured in Jack Schwager's Stock Market Wizards book, Conversations with America's Top Stock Traders. And of course, he is author of the best-selling book, Trade Like a Stock Market Wizard, How to Achieve Super Performance. First thing I should just mention to start off the event is that there is no recording of this event. We do not have any replay of this event scheduled at this time. If there is, though, we will be sending out some type of communication with you via your email. In order to get a copy of Mark's #1 best-selling book, if you do not already have that, that is available at Amazon.com, Barnes & Noble, Books A Million, and most major booksellers. David Ryan also is where we are announcing today our 2015 Master Trader Program Super Performance Workshop. This is with special guest presenter David Ryan, who is a 3-time U.S. investing champion, along with Mark, and he is featured in the Market Wizards books, also from Jack Schwager, if you're not familiar. And the event is being held this year in October 24th and 25th, the weekend, at the Grand Dunes Marriott Resort in Myrtle Beach, South Carolina. For information, you can go to our website at minervini.com. Also, the picture of the book that you have at the top left corner of your Omnovia screen, if you click on that book, that will also take you to the website that will provide you the information related to the Master Trader Program event. Another quick thing to note is that you can maximize this screen on your Omnovia. There's an icon at the top of your toolbar, which does give you the option to select a full screen viewing of the presentation today. At the Master Trader Program, this year is, as past years, a voluminous workbook that you do get to keep and take home with you, which is over 275 pages, listed with everything regarding fundamentals, charting, what drives the moves, how to buy before breakouts, precisely when to buy, precisely when to sell. You also get Mark and David's screening as well as their daily routines. It is an A to Z, soup to nuts, full, complete information about Mark's SIPA methodology, including as well his risk management, position sizing, post-analysis, as well as how to scale in and out of positions, and much, much more. We also offer our Minervini Private Access Premium Membership Service, and that is where you get to earn while you learn. And this is where you do get information such as Mark's flash buy alerts, flash sell alerts in real time. It also is enabling you to be hearing Mark's market commentary. You get to, on a weekly basis, not only have ongoing idea generation throughout the week, but also you have access to Mark through his live Q&A presentation, which is where you also get to see his computer screens live online. And that is also where he discusses his top picks, our specific entry and exit points, and again, his market analysis. We also do our post-analysis of past trades there, and using our logging software is where you have the ability to have all your trading activity logged and analyzed. We do offer some special discounts today for attending today's webinar, and that includes a $1,000 discount off the Master Trader Program for this fall, as well as the $1,000 discount if you subscribe to the annual subscription of our premium platform membership. If you are looking to do both events, what I would say is to simply email me. Our email address is where you already received the information regarding this webinar, but it is minervinipa@gmail.com. Simply email me your name and phone number and best time to call, and I will let you know and reach out to you about a special combination discount that we do offer. It's a much more significant discount than what you're seeing here. This special does expire this Sunday night. That's March 29th, 2015 at midnight. So bear in mind that these discounts are only available till this Sunday. And with that, let me step aside and introduce to you your host for today, of course. Your guest speaker as well is Mark Minervini and David Ryan, and this is for Super Trader Tactics for Triple-Digit Returns.
Okay, great. I'm going to do a quick summary. David's going to do one too. We're going to just make sure everyone's hearing me okay. Let's see if anybody's not hearing me. Type a 2 if you're not hearing me. That's a joke, of course. Type a 1 if you're hearing me. Yeah. Hold on 1 second. And what's that? Hold on 1 second. I'm just getting. Hey, Dave, can we see if your microphone's working too?
I am here.
Okay, great. Okay, and if you can hear David, type a 2. Okay. Oh, lots of 2s. Okay, great. Looks like everyone's hearing us pretty good here.
Very good.
Okay, just 1 second. We're going to get started here. I'm just setting up my screen and my microphone. Okay, great. I first want to welcome everyone because we have attendees here from all around the world at different time zones, and want to welcome all of you. I see we have people from India and from Australia and all over the world. As you can see, Bob just brought up a map of where everyone's coming from, so it's pretty spread out around the globe. So welcome everyone, and also want to point out that I know we had people were asking if you can ask questions. You certainly can type in questions, and we'll try to get to as many as we can at the end of this presentation, but we're probably not going to be able to get to them all because there's many hundreds of people here today. However, David and myself are being interviewed right now for a book. It's sort of like a Market Wizards book, but it's for momentum trading only. It's called Momentum Masters. Probably be out sometime at the end of the year. Richie the second, and also Dan Zanger, who you might know. Dan has had some phenomenal performance also. So it's going to be myself, David Ryan, Dan Zanger, and Mark Ritchie, who's going to be answering in a roundtable sort of interview format in a new book that's coming out at the end of the year. I'm also working on a second book that's not scheduled for until the following year, so there will be a sequel to my Trade Like a Stock Market Wizard also. Okay, so we're going to start here, and today's topic is about getting big returns and getting returns consistently as well. And the reason why I have David Ryan here with me today is because there's not too many people better than David knowing how to get triple-digit returns and to keep drawdowns low. David, of course, won the U.S. Investing Championship 3 times in a row and had triple-digit returns all 3 years. He's had many years of huge performance. So we're going to get into this today and have a lot of fun. We're also going to be talking about how to keep drawdowns small, and that's one of the big keys for triple-digit performance. So let's get started. Dave, if you're ready. See here. Yeah.
Ready?
So the first thing we want to talk about is that there's some major keys that you need to know to get this type of super performance. And we're talking about big returns, not beating the market by a few percentage points or getting even 20 or 30% a year. We're talking about 50, 60, 100% a year or better. You know, triple-digit returns was always my benchmark for what I wanted to achieve on a yearly basis. I was fortunate to be able to have triple-digit returns in about 70% of the years over the last 2 decades. So you can obviously do the math and figure out how many years I've had triple-digit returns during that time. Most of the other years I was up close to triple digits or in the mid 50, 60%, and had very few years that were even single digit. I had a few years where I broke even, but that was about it during bear markets. So the question is, how do you do that? Is that something that you have to have some special innate talent for? And I don't think so. I think it's just something that you have to realize. There's some principles that you have to follow, and we're going to talk about those. The real keys are, one, you have to be able to make when things are really working for you and the market's good, you need to be able to make some big returns when you're correct. And also, you need to be consistent. You don't have to make big returns all the time, but you want to have consistent profits. And probably the most important thing is that you want to avoid big drawdowns when you're wrong. If you have big drawdowns, even big performance is not going to really add up to much, because you're going to be giving back a big portion, and then you got to come all the way back, and then it takes all this time just to get back to where you already were. So we're going to go over some rules that I've applied, and that also that David uses to be able to get these type of returns. And the thing is that much of this is going to go against conventional wisdom. All right, remember, conventional wisdom is going to get you conventional returns, and you're going to have to go outside probably what you hear most of the time, or what you think is normal, or what is comfortable to you. To be able to be exceptional, you're going to have to do things that are unusual, or maybe feel like they're not the norm. Dave, you got anything to add before we start on this next rule?
Well, I think the most important thing to me is that once you have got the right method, you've got the right rules, you've got to be extremely disciplined. And that discipline will take out the emotion that so many times leads to losses among traders and investors. So the right method, the right discipline, or being disciplined, and then also you got to concentrate. You can't have 20 stocks and think you're gonna have very, very big returns. You have to concentrate and bring it down to at least 10 stocks or
Now,
less
David
than that.
doesn't even know what the first slide is, just to let you know, and it's concentrate. Way to go, Dave. So that's
Okay.
a nice segue into the first slide, and I swear to you, he doesn't even know what this first slide is. So rule number one is like David said, concentrate. Don't diversify. Now, that doesn't mean that you don't want to have no diversification. You're going to have some diversification, but I know in my own trading, even to this day, I'm not widely diversified, and I'm much more conservative than I was when I didn't have a whole lot of money, and and my portfolio wasn't that large. But even David, he's pretty concentrated even to this day. Although, again, we're going to talk about more the kind of trading that we did when we were really going for those huge returns, to start with a smaller amount of money and turn it into a large amount of money. I started off with a very small amount of money, just a few $1,000s, and then I eventually added some money to it. It got up to about 10,000. Finally, over a few years, I got it up to about 30,000. Now, that's not a whole lot of money to start with, but I turned that into 150, and then I turned it into $500,000, and then I turned it into $1 million change, and it just kept going. All because I was able to get really big returns year after year. Now, what I would normally do is I would put most of my money in just 4 or 5 names. So we're going to talk about that in just a minute. The reason why you want to concentrate is a few things. First of all, you want to be able to manage things. And if you're spread out all over the place, you're not going to be able to know what you need to know about each stock, and you're not going to really be focused on those holdings. And I can assure you that if you have big positions, you're going to be much more likely to be very attentive to those positions, because you know that if one of them move against you, you can take much bigger losses because you have such concentration. So it's going to automatically keep you focused. And here's the other thing: it's going to allow you what I call the luxury of integrity, or the luxury of being patient. And the reason why you're able to be patient is because if you concentrate, when things work, you're going to be able to make money very rapidly. Now, of course, on the flip side, if things go against you, you would lose very rapidly, and we're going to talk about that also. That's why you have to be able to manage the risk. But you are going to be able to play catch up. Let's say you're out of the market for 4 or 5 months and the market's even moving higher. It doesn't ever bother me. I don't care if I'm out of the market for long stretches of time, because I know that once I go into the stock market and I start buying positions, if I'm pretty concentrated, then I'm going to be able to move my equity up very rapidly. But I want to make sure that I'm in at the right time. So I do that very carefully. And I focus on the very, very best names. That's another thing. So if you are only going in, let's say, 4, 5, or as many as 8 to 10 names, well, when the stock market has 8 or 10,000 choices and you're trying to boil it down to only the top 5 or 10, well, you're going to really boil it down to the very, very best names. And that's really important that you are able to really, really focus on the absolute best names to make the biggest moves and the biggest return possible in the shortest period of time. What do you say there, Dave, on this rule?
Yeah, I would say, when you are concentrating, you don't have to concentrate. I'd say you have to do it in steps. I mean, I usually take my portfolio, I divide it into 10 sections, a 10% position in 10 different stocks. And then that's where I start. I usually buy a 5% position, and within a day or two, that's up to a 10% position if the stock starts moving very well. Then for that stock to get up to a 20% position or even more, I want to see that stock make a nice move, build another base, and then I'll even add to it on that second base. And so then the stock is maybe a 25% position. And that's where you really get some great gains, is you play them over time, and you don't do it, you don't try to go for the home run where you take your whole portfolio and divide it into 2 stocks and 50% in one, 50% in another. Start a little bit smaller, and then you gradually get it in, work it into a bigger position as the stock starts making profits for you.
That's right. And I shoot for 20 to 25% positions. That doesn't mean that I come right out of the box and I go right to a 25% position. I might also buy a 5% position. If things are really kind of sketchy, I might even just get what David calls a mental health buy, where I just buy, a few hundred shares or something, just to have something to watch and get myself involved. And then if things start picking up and looking like they're working, then I'll move it up. But once I see that things are working, then I move very quickly, and I try to get as much as I can into a handful of the better positions. Now, let's move forward here. Now, the second thing, and again, most of these are going to go against, they're going to go against common wisdom, or what you'll normally be told you need to do. What we're normally told, you need to diversify, right? Spread it around over a bunch of stocks so you can protect yourself. Diversification is definitely not going to protect you, all right? It's just going to dilute you. The other thing that you need to realize is that you're going to have to turn your portfolio over. There's a few reasons why you're going to have to turn it over. One, you're going to have to take profits when you have them, and you're also going to be trimming off the stocks that aren't working out so well. So your portfolio turnover is going to go up. Portfolio turnover is not a problem if you're taking profits and you're cutting losses and you're keeping your losses smaller than your profits. Then portfolio turnover is a good thing. It certainly could be a bad thing if you're just, whipping it all around and you're churning yourself into the ground with a lot of trading and not much to show for it. But what we find is that a lot of people don't sell because they don't want to pay the taxes. So then they end up the stock moves against them, and they end up having a loss, and then they don't have taxes to worry about. Or they saw a previous high in the stock, and when it gets back to that high, I'll sell it. Or they're at a loss, and when it gets back to even, I'll sell it, and the loss keeps growing. So you want to forget about the taxes, forget about getting the high, because you're virtually never going to get the high. I've been doing this for 30 years, and I don't think on maybe a few occasions I've gotten the absolute high in a stock. And you want to forget about your ego. The goal is to make money and to protect yourself. So if you're trying to be right all the time, you're going to have a problem. But if you divorce your ego and you forget about being right, you're going to find that you're going to turn the portfolio over a lot more. You'll find someone like Kenny Hebner, who is a great manager and runs billions of dollars, has a lot of turnover, but he also has one of the better track records. And a lot of the guys who have the bigger track records usually have the more turnover. Now, you want to nail down profits when you have them, at least a portion of them, and that's another thing that's going to create a lot of turnover, especially now. There's a lot more trading nowadays. Dave, I know, we've had a lot of discussions about this, and you've talked about how I say that things are really never different. However, I think being faster isn't really different. It's just the same thing, just at an accelerated pace. And because of, you have access to the internet now. Back in the day, we had to pick up the phone, call somebody, they had to call somebody, they called them back, they called us, there was a $250 commission, so it was a lot harder, to move quickly. Now, of course, you just make a click and your positions are bought and sold, so things move faster. But you want to talk about this a little bit, and your view on how things have changed maybe a little bit as far as that's concerned, and how you've altered your trading?
Yeah, I think, with the fact that everybody's got a computer, everybody's connected, you can just push a button and you can execute the stock within a second. It has, to me, sped things up, and you have to be knowledgeable of that. You have to be aware of that, because sometimes you'll see a stock break out, and the only people aboard that are moving that stock higher are just a lot of traders who have their alarms set. And so you have to see, is there follow-on volume? Does the buying continue, not just for today, but then for the next day or in the following day after that? So things have sped up. You have to be careful. I tended to not do anything in the first 45 minutes of the market, because there's just a lot of emotion, a lot of news moving things down. I actually like to see intraday, as stocks calm down, to place some of my orders, or even wait until towards the end of the day to see, because you can get whipsawed in some of the sort of the computer type of moves that occur. And just adding to your rule number 2 on turning over your portfolio, yeah, I never ever think about taxes when I'm buying and selling, when I'm selling a stock. I'm thinking of, is the position right to be sold? Should it be sold? And I never even think about taxes. I've never thought about taxes. It's lots of times you might think, oh well, I can't take that position now because I'm going to have to pay a big tax hit on that. But lots of times I've seen people who've said that, who then a few months later they're now underwater, and they much rather pay taxes on a profit than no taxes on a loss. And your third point, forget about your ego. You have to take, I've always said, you have to take your ego, you got to throw it in a trash can when you walk into the trading day or the investment arena, because you are going to be wrong. And if you're wrong 40% of the time, even 50% of the time, you can still do extremely well in the market. You just have to keep those losses small. You have to be able to admit that you've made a mistake and move on to the next stock. Learn from that mistake, but take that first loss and then move on. So forget about your ego, and just and learn from your losses, learn from your winners.
Yeah. Now, moving on here, the next thing that you've probably been told many times is that you can't time the market. I just especially in nowadays we have the ETFs, and of course Bogle is Vanguard is the big proponent of buying and holding in the market. When it does well for year after year and you have a big bull market, see, if you just held, okay, that's great. But first of all, we're talking, number one, about super performance here. We're talking about triple-digit returns, and you're not going to get triple-digit returns by holding the S&P 500. That's number one. Also, it's if there's any one thing that maybe has changed over the years is back in many decades ago, you could buy AT&T or a bellwether stock and hold it for a long period of time. But even then, you had big bear markets that took these stocks down 50-60%. Some never come back. So you have to remember, time is money. And I've been timing trades since I started in this business 30 years ago. David's been timing his trades for for 40 years, and we can go on and on with many successful traders who time their trades. So can the market be timed? Well, I don't know about the general market. That's probably a lot more difficult, but individual stocks can be timed very effectively. The thing is, you have to learn to use charts, of course, and I know many of you do use charts, but you have to use them correctly. And one of the things that I would point out is to just learn how to identify what I call the volatility contraction pattern, or the VCP setup. And what this allows you, and when you're able to with pinpoint accuracy, go in there and buy a stock and know very quickly whether you're right or wrong. What happens is, first of all, you're able to compound the money very rapidly because you're not wasting time. When you're right very quickly. And on the flip side, when you're wrong, you're out of it and you can move on to something else. So time becomes your friend. I'm going to show you a setup here that not too long ago that we bought. I purchased myself, and we purchased it at the on the platform here. And this is a classic. There's a few things that are happening here. One, you have what we call a primary base. It's the first time that you set up a constructive price setup from a new issue. So over here you have the new issue, and like many of these new issues, sometimes they run up real quick, but usually after that run up they correct, or they correct right away, and then they spend some time going through a correction or some type of sideways action, and some even go up and take off and double first before they actually spend that time correcting. But I always wait for some type of consolidation, and then from there I look to buy as the stock starts emerging from that consolidation. Now, you can apply the VCP to to new issues, or to a stock that's been around for a long period of time. This is the entry point that we made, and that I purchased this stock on. And if you go, we're going to take a look at a little bit wider view on where it is now. So you can see that this stock, this came out very efficiently, and this allows you to be able to now, first of all, take, if you're a shorter term trader, take a very quick profit and be able to compound that money more rapidly. But also, if you get yourself at a profit right away like this, then you can sit through some of this pullback, because you've gotten yourself in a position where you have some cushion. And so there's multiple benefits that you're getting from timing the trade correctly. Now, on the flip side, let's just say this stock tries to break out and then comes off here and starts falling back. Well, now I know that it's acting abnormal. This is not what should be happening. This stock should be following through and moving up and having successive days of price increase. And now I know to get out of the stock. So it's really allowing me to know that that train is coming in on schedule. Now, you can read about this in my book. I put the page number here. There's a section called "A Picture is Worth $1 Million," and then there's a subsection on the VCP. But the whole section, of course, you should read. It's on page 189, and I explain this in much more depth. Of course, when we do the Master Trader program, we spend 2 days, and there's hundreds of examples of this, which will be in not till October, though. Dave, anything to add to this?
Yeah, one comment on the indexing and how popular that's become. Anytime I've seen something become so popular that everybody's starting to do it, that you're probably getting towards the end of that. And I think maybe the example of the market even in the first 3 months of the year is a great example. Well, the market is just going back and forth. I mean, we were up a few percent coming into the day, and now we're barely up on the S&P. We're down on the Dow, and I guess the Nasdaq's up a little bit. But if you've been able to hit the right stocks, buy the right stocks, and take them out, you might have been able to make a little bit more progress in the market. And so I'm thinking that it's been a long time since really stock picking has been in vogue, and it's been all indexing for the last 6 years. So this might be, maybe we're starting to turn. Maybe this might be the day of the stock picker. I'd love to see that, because I just love picking individual stocks that can outperform the market.
Yeah, I agree with David, and I think that maybe after we have a decent sized correction, the next type of, and I'm talking about some type of maybe bear market, a real good size reset. I think coming out of that, we may go back to a stock pickers type environment. And like David said, we haven't been in that type of environment in a long time. It's been where indexing has been working. But again, it really, regardless of what's working with the indexes, with individual stocks, there's always you get leverage with the individual stocks. If the general market goes up 20%, and you're in a bull market run, you're going to have individual names that double, triple, and some go up tenfold and 20-fold. So you get a leverage factor there, and timing the trades really becomes something that is going to be able to give you that compounding. Now, of course, we talk about the upside on these trades and timing them properly, but you have to remember that you're not going to be right all the time. As a matter of fact, even if you're really good at this, you're probably only going to be right maybe half the time. I mean, when the market's going really well, I sometimes have a 65% batting average when things are really working for me. But generally speaking, it's about 45 to 50%. And when things are not going so well, it's 35%, 40%. And if it gets below 35%, I usually know that's a sign that things are really not too good in the market, and I scale back my activity quite a bit. Dave, what as far as that's concerned, what are your feelings on that?
Oh, yeah, you always have to, as you're going into a trade or into an investment, you have to set a spot where you get out, because as someone said, the mind's got an infinite capacity to rationalize, and a stock starts down on you, you can come up with every excuse in the book of why you shouldn't sell. But I always set at least some point, maybe it's 8%, maybe it's 5%. It depends on maybe even the setup of the stock and how the stock is coming out of a base. But you have to, as you go into any investment, that you have to set those stop loss points, because you just don't want to suffer a huge gain, because it is so hard to come back from those losses.
Huge loss. Yeah, you mean a huge loss. You said suffer.
Yeah, a huge loss. Yeah, yeah. You don't want to suffer a huge loss, because it's very, very hard to come back from it.
All right, so let's talk about and be a little more specific. And I know you guys want tangible things that you can use. So let's talk about managing the risk reward relationship. This is the holy grail. If there's any holy grail, this is it. This is what trading is all about, because really, it just comes down to doing the math and figuring out where you need to cut your loss relative to where your gains generally expire. So it's no different than what insurance companies do with mortality tables, and that's how they charge a premium, because they have a really good idea of where the people are going to die on average, and it'll fall right on that age pretty specifically when you take an average of it. So you can look at your own trades and say, all right, well, on average, I'm getting, let's just say, 12% gains over the last, say 100 trades in the last 6 months or a year. I did 100 trades and my average gain is 12%. Well, and take a look at how many times you've been right. I've been right, 50% of the time on half the trades. Well, does that mean that you can take bigger than 12% losses? No, there's no way you can take 12% losses and make money. So you're going to have to take losses less than 12%, unless your trading all of a sudden improves dramatically overnight, which it probably wouldn't. Over time, it may improve somewhat, but then if you monitor your gains regularly, you'll get an idea of what you're producing when you're right, and then you can adjust that loss, and then that loss should be at 1/2 of your gain or your expected gain, and then even 1/3. Using a 3-to-1 or a 2-to-1 is a general rule of thumb. And if you go and you look at most traders that are even swing traders or even longer term traders, investors, they're cutting their losses. If they're successful, their losses are generally cut at 1/2 to 1/3 where they're getting their gains. Now, the other thing that you want to realize, I always talk about building in failure. And I'll just explain real quickly what that means. This means that instead of trying to worry about being right all the time and having a big batting average and being successful on 80% of your trades, which is very difficult to do, what you want to do is actually use the risk-reward relationship and cutting your loss relative to your gains as your edge more than the actual number of times you're right. And what I try to do is I try to be profitable when I'm only right 35% of the time. So in my mind, I'm saying, okay, I want to keep my I want to manage my risk-reward relationship. So when I'm only right 30%, 35% of the time, I'm still not getting into trouble. I'm breaking even. So you can do the math and back into that, but then I've built in a lot of failure because at that point, I mean, even I can be right probably 25% of the time throwing a dart. But so, but if I'm needing to be right 80% of the time, and my average loss is 15%, my average gain is only 10%, and I'm upside down with the risk-reward relationship, but my edge is coming from the fact that I'm right all the time, or not all the time, but a good portion of the time. When you're wrong and that moves against you, and you start to have a drawdown in your batting average, you're going to have a huge drawdown because your system is not able, hasn't built in any failure. It's planning for the best and expecting the best. So I plan for I expect the best, but I plan for the worst. Let's move on here. Of course, we don't have the time to go into every one of go into everything in great detail. We're going to try to touch upon this and answer some questions. So I apologize that I could go on and David could go on for this, with these topics for days on end. Excuse me. So what I do is I approach every trade from a risk-first standpoint. I had a tickle in my throat, sorry. And I know exactly where I'm getting out before I ever get into the stock. And I, to this day, I still have it committed to paper. And after doing it for 30 years, I still don't trust my memory with anything. Well, actually, I trust my memory less now that I'm 50. But I write it down. And then when that stock hits that point, there's nothing to think about. I just get out of it. I'll go and I'll reevaluate, and I might come back to it later on. Sometimes I get shaken out of a quick move, but at least I'm protecting myself, and that risk is always thought of as a function of my expected gain. And this is the number one single most destructive thing that every investor does, is that they don't cut their losses properly. And even if they do cut their losses, many investors only do it on some trades, and some trades they don't. And every now and then they fall in love with something. It ends up turning against them. They hold it down, and just a few stocks end up destroying what could have been really good performance. And then you look back and you find out that it's just a few bombs that hit your account that really messed you up quite a bit. And then you have some traders who they just refuse to look at that stuff and keep moving forward, and never really know why they went wrong. So it's really important to make sure you know where you're going wrong. Now, I have a little sign that's on my desk that I've kept for quite some time. There's a few things I do. First, when I wake up in the morning, the first thing I do when I go into the bathroom is I look in the mirror, and I've been saying this same sentence to myself every day, and I say it internally in my head, but I've been saying the same thing to myself every day for decades now. And that is, I walk in, I look in the mirror, I say, Mark, you have the ability to do serious damage to yourself today. And then I go into my office and I start working. And the reason why I say that is I always want to remind myself that I could get really hurt in the market very easily if I just fail to adhere to some simple rules. The next thing you know, I'm taking very big problems in my account and in my confidence as well. And I also have a sign on my desk that says no big losses, no forced trades. And simply, I'm always trying to remember, I want to keep the losses small, and I don't want to force things. I don't want to try to make something happen that's not there. I'm going to wait for the stocks to set up the way I need them to set up, and if they don't, then I wait. And I wait patiently. If you remember, we go back to the first rule. If you're concentrated, then you can make things up pretty quickly, and you don't have to be so worried about being in cash and sitting out of the market. Also, I mean, if you're in it for action and you can't sit on your hands and wait for the market to set up properly for what you need to see for a high probability setup, well, then you're probably better off just going to Vegas and having some fun and you'll lose your money there, and you can start all over. But that's where you're going to end up being if you're going into it for action. You're basically going to be going to Vegas. Now, Dave, do you have any? I don't know if you have
Yeah.
any signs in your anything that you say on a daily basis to yourself.
Well, when usually when I wake up in the morning, I look in the mirror, I look at myself, and I go, "Oh my gosh, you're getting so old."
I say that also.
Yeah. But but yeah, the key, no big losses, no forced trades. That's very good to have. I think a lot of people are going to say, well, do you set mental stops, or do you set stops in with your broker, or put them in online? I actually do them online, because if you put a mental stop in, or you write it down, and then you have to watch it, every single second of the day as it's starting to get closer to your stop point. I just put them in, and if I get taken out and then they whipsaw me and they come right back up, well, I'll buy them again on that next setup. But I like to put them in. I like to put them in as I'm placing the trade. On the buy side, I like to put in my stops with my online broker at that same time. So then I don't sit there and argue with myself, or I don't start rationalizing as the stock gets closer and closer to my stop. It's immediately triggered, and I'm taken out. And the reason why I say that is that you have to develop something where you are extremely disciplined. I hate to sound like the coach or the teacher, or even your dad or your mom, where you say you got to practice discipline, but so much of this is removing the emotion by being disciplined. Setting your losses as you're purchasing the stock, and just almost being, I've called it's like being a robotic investor. You see the information, you act on it, and when the thing starts turning down, then it's time to take profits, or it breaks moving averages, or whatever it is, you have to just go in and act instinctively, and not use all these emotions that we can get caught up into, and which creates big losses.
Yeah, real quick, I just want to point out something. I know we've had maybe, I don't know, a handful of people, looks like maybe 5 or 6 people that are saying fix the audio. We've got, I think, 800 people on here right now. And there's like 780 something people that are hearing it fine. So it's not on our end, just so you understand. You might be on a wireless or whatever, for whatever reason, but we apologize for the few people that are having problem with the audio. But we've got like 700 people that are not having problem with the audio. So it's definitely not on our end, and there's really nothing we can do. I really apologize for that. Anyway, let's move on here. Now, this is something that that I really believe is important. I mean, these are all important rules, but some are just not followed nearly as much by people, and they break them. And this is really important, to trade directionally. And when I say trade directionally, I'm talking about this on a longer term basis, right down to the very shortest term basis on an intraday basis. Let's start with the longer term. On the longer term, you're going to want to trade with the trend in your direction, the longer term trend. Again, you can go to my book, and I talk about this. There's a trend template, and that's the criteria, the 8 criteria that must be met, or I won't even look at the stock. I'm not even going to see the stock unless it's meeting this criteria. And then from there, I'm going to want to see the VCB setup, the intermediate term chart pattern also have that uptrend, and then finally, when I'm buying the stock is actually moving up. Now, the thing is, I buy on pullbacks, and so does David, but almost every time, even on a pullback, we're waiting for the stock to actually start turning up. So maybe the stock pulls back and undercuts its 50-day or whatever the pullback buy may be. Most of the time, or almost all the time, almost never am I buying when the stock is actually coming back in. I'm waiting for it to have some type of stabilization and actually turn up. So what I'm trying to do is align all the time frames. So every trend across the board is in my direction, and you'd never want to average down. Not what's even worse than buying when the stock's coming down is to buy more when it's coming down. It comes down and then you buy it and then it comes down more, so you buy more and you average down. This is something that a lot of brokers try to convince clients to do for obvious reasons. It's the guaranteed way to the poorhouse at some point. You may get away with it a bunch of times, but somewhere along the line it's going to really hurt you. Now, again, we talk about determining if the train comes in on schedule. When you have all these trends in your favor, it becomes very obvious to see that when things aren't working, because you're going to move against so many different forces that are in one direction. And again, this is something that I talk about quite a bit in my book, about determining when that train is coming in on schedule, and then coming in right at the moment where that stock is starting to move, and you want to try to buy when momentum is the strongest, when that stock is really on the move. Dave, I know you trade directionally, virtually all the time as well. Can you elaborate a little bit on this?
Yeah, I never buy when I never average down, because I've already made a mistake on my first purchase. Then why compound it by adding more to it? Well, maybe it could rally from there, but I've already made a mistake, and so it's just a rule, because I have just seen stocks where where I'm down on them and I go ahead and sell them out, and just cannot believe how far some of these things can fall. Because the stocks that I'm in and the stocks that you're in, Mark, that are usually strong, very strong growth companies, and when that growth really starts slowing down, the stock can fall dramatically. So if you're averaging on the way down, you could have some very, very big losses in a very short period of time. So as a very specific rule, I never add to stocks or losing positions where I've already got a loss in it.
Yeah, and now here's a guy, okay, here's David Ryan, who's one of the best traders in the world. He's been doing this for 40 years, is not trusting his own opinion. See, he's not trusting that. He's saying, I bought this stock. It's not going in the direction that I thought it would go. It's going against me. And I don't trust my own opinion. I'm going to trust the action of the market, and I'm not going to go and add good money after bad. And so if he's not trusting his opinion, why should you, and dig in? So it's really important to understand that your first loss is your best loss, and if the stock's not moving in your direction, then guess what? You made a mistake in timing. You have to admit that you've made a mistake in timing. Maybe it's just a temporary short-term mistake, and the stock will get back on track a few days, a few weeks, or even a few months down the road, and you can come back to it. Or if it hasn't hit your stop yet, you stick with what you already own. But the last thing you want to do is start to add to that. I know we had a question asking, how do you know the intraday trend is up? Well, stock is moving up. I mean, it's that simple. If the stock has been moving down and it starts to turn up, that's of course the shortest time frame, or it's up on the day. If the stock is certainly up on the day, then the stock's moving up on that day. But the point is that if you buy when the stock is falling, it's almost never that you get the absolute low, just like you don't get the absolute high. So you're probably going to be sitting at a loss right away. And how big that loss is going to be is anybody's guess. And if you're using stops, it only has to go down not much more, and you'll probably get stopped out. So you're trying to avoid getting whipped around, and you're trying to get on the stock trade when it starts to make a big move and be at a profit as soon as possible. As a matter of fact, and I know this is one of David's main rules, is not only does he want to see and do I want to see a stock give me a profit immediately, right after I buy it, within literally seconds and minutes, I expect to be at a profit. Now, that doesn't always work out that way, and I'm not going to sell it just because I'm not at a profit right away. However, that's the optimal trade, and that's the best sign that I'm going to make money in the trade. And even a better sign is the next 2 or 3 days I have follow through, and the stock moves even higher, and I'm at a profit for several days. Those are usually the best trades. Do you find that to be true, Dave?
Oh, always. The best stocks are the ones that are actually hard to buy. And so when you're buying it, you've got a lot of other investors, maybe some huge hedge funds or mutual funds that are on the same side of that trade. And we're all scrambling to get those shares, and you buy some and it goes up, and then you try to buy some more and it's hard to get. And that's the market telling you that you've got, probably your timing has been very good and you've got a good stock on your hands. And as you mentioned, I don't want to see a stock that has a one-day breakout. I mean, I can't tell you how many times stocks, they come out of bases and they get one day of buying, and then all of a sudden they turn around and they drop right back into the base or go right back through the bottom of the base. And recently that's been happening a lot, and that's not a very good sign for the overall market. But
No.
but yeah, when I'm buying, I want that first day up, I want to be up, and then I want to see just as many days in a row as possible to the upside for that stock.
Yeah, and now there was a question asking, is there a reason why the VCP, why these stocks can move so rapidly and off of the VCP? And yes, there is. There's a reason. This is not hocus pocus, or this isn't the cause. It's the effect. It's the effect of a greater cause. We're just reading supply and demand, and the better that you are at reading supply and demand, the more accurate you're going to be with this stuff. Now, what David just said is really a golden nugget here. Now, when the difference between a breakout that the stock pops out of the base, then comes back in, and then falls apart, is the difference between retail buying and institutional buying. This is really something that's very important that you want to understand. You're trying to align your purchases with big institutional orders that are buying that stock at a time when there's very little supply. See, this is where the VCP comes in, where you quiet the stock down and it gets very tight on that right side after contracting and the volume comes in. That's telling you that stock supply has stopped coming to market. What that means is that now it only takes a little bit of activity to move that stock. So it creates the line of least resistance. And that's why they're so explosive when they come out of these chart formations, when you read them correctly. Really important to study. If you study this stuff right, you won't have to listen to anybody. You won't have to get tips. You won't have to guess. You'll see it right before your eyes. You'll take action, and then you'll simply wait to admit whether you're right or you're wrong, and if the stock is, the train is coming in on schedule. So the difference between retail buying and institutional buying, that's what you want to learn how to identify, and that will help you not only time the trades correctly, but get at a profit very quickly. Now, here's another major rule, and I think we're getting into now the rules that are really important for keeping your drawdowns small. Now, I've had huge returns, and I've made a lot of money in the stock market. However, that is not what I'm most proud of with my own my own performance. What I'm really proud of is the fact is that over the years, I've never been caught in a big decline. I've never had a real big problem in my portfolio, and my drawdowns have been very small. And that's trading extremely concentrated and being very aggressive and being through a lot of turbulent times. What is the reason for that? Well, after trading hundreds of thousands of trades, it's certainly not. I couldn't get lucky 100 or 200,000 times. So there's a method behind this madness, and one of the really important rules that you can start learning how to apply is to build on success, and it's very simple. First of all, trading is not an on or off business. David alluded to this right in the beginning. He said, I'm not going to just go in there and start trading large. I'm going to take a 5% position, and if things start working, I'm going to step up my exposure. I'm the exact same way. As a matter of fact, I play poker that way. I'm not really getting aggressive and getting creative until, I've made some money and I've built my stack up a little bit. I apply the exact same thing to the stock market. I let my smaller wins finance my larger risk. So, for instance, I first entered the market maybe from a cash position. Market's been in a correction, and I'm knocked out of all my trades. I'm in cash now. I come in and I might buy one or two stocks and take some smaller positions, maybe a 5% trade, maybe even a 10% position. And if those work and things start and things start moving in my direction, I might take another trade. I will almost certainly take one or two more trades. And as I start getting some traction, I'll start increasing my size, because now those profits are financing my forward risk. So now on the opposite side, if the market starts moving against me, or the stocks start moving against me, and I start getting stopped out of names, I trade progressively smaller. So what this does, and it's really important that you do it on both sides. Okay, this I've seen people do it on the loss side, where they scale back, but then they don't scale up, and they get afraid that they've gotten some profits and they don't want to give them back, and they're afraid to get aggressive. But if you get aggressive when things are working, and you get conservative when things are not, what will eventually happen is you'll be trading your largest when you're trading your best, and you'll be trading your smallest when you're trading your worst. So when the market really takes off and everything starts really working, you'll make a lot of money. And when things roll over and you go into a bear market, you'll be forced to cash or very, very negligible positions. It's an automatic way to keep yourself pressing the gas when things are working, and riding the brake when things are not. Now, the thing is I'll go in there and I'll get in maybe 25% invested when I first put my first toe in the water. If things work, I'll move it up to 50, and then from there maybe 75, and then I'll go to 100%. And for some of you that use margin, you can then maybe move on to margin. But if you're not profitable at 25% or 50%, and you're losing money on your trades, well, then what rational reason would you possibly have for stepping it up even more? Things are not working. The trades aren't working properly, and what you expected to happen isn't happening. So you're going to guess, and now you're going to revenge trade and try to get it back quicker and double up or start moving heavier in the market, and that's precisely what gets you into a lot of trouble and creates big drawdowns. With this way, you're going to have very few times where you're getting in real trouble, because you're never really putting on any size until you've already got some profits. Any thoughts on that, Dave?
Yeah, there's no reason to add when you're not making any money. It's another trader, an old gentleman who I've seen trade for years, would always say, I'm not getting paid to take this risk. I'm not getting rewarded, and so there's no reason to keep on adding and adding and adding, and filling out more positions when you're not even making money on the first one. So it's always, you should be bending with the market. If the market is going up, your stocks are doing well, then you should add to those positions, or add on new positions. If the market starts coming off and starts rolling over, well, your stops are probably getting hit, and you're coming out of the market as those stops are hit. So you're constantly kind of moving back and forth, or with the direction of the market. I mean, it's almost like driving a car. You see a red light up ahead because you have stocks that are starting to get hit. Well, you start hitting the brake and slowing down, and if you see a green light ahead, your stocks are doing well, you hit the gas and you add more positions, or you add more money to your existing positions.
Yeah, absolutely. Now, I see we have some questions. We have someone from Dubai asking if how do you scan and pick your stocks? Now, I want to explain something. Of course, we're not going to be able to get into this, these specifics of the whole strategy and exactly what we do. That's something that we do for several days of training at the Master Trader Program. If you're real serious about learning this from A to Z, that's where to come. Or you can come onto the platform, our premium platform, on a daily basis, and then we do it right there live, and we answer questions every week. This is something that's going to take time, okay? And you don't have to use my strategy. You could be using some other strategy. These rules are really are applicable to any strategy. It's not strategy specific, and so you have to realize the main thing is that you're applying good, sound rules and making quality choices with whatever strategy. But if you want to learn, what we do in my strategy, you can. Of course, the book is the cheapest way to do it, and I'm explaining probably 90% of it in there. I have another question here. Is the VCP in the book? Yes, it is. There's a big section on it. It starts on page 189, and also. I see here, I'm just backing up here. I'm trying to go through some of these questions because I know it's going to be tough at the end. Do you think VCP would work in S&P 500 stocks? Absolutely. It doesn't matter whether large cap, small cap. I mean, I favor the small and mid cap names because they're a little less efficient, but it certainly will work in S&P 500 companies. Absolutely. All right, let's move on here. Now, the next rule is talking about protecting your break-even point. And this, again, this is really to help your equity curve and to keep your drawdowns to a minimum. And the way I do that is that I try to protect my break-even point as soon as I can without choking off the trade. Okay, the ASAP, and I know. I think Vicky, I think you asked me a question in the trading room on Monday, and I didn't get to answer it, and it was specifically on this, if my memory serves me correctly. And you were saying, what's the ASAP? You know, how do we determine ASAP? Well, I'll tell you how. I'm going to tell you how I determine it. When I get where I've risked, let's just say, I'm going to give you a hypothetical situation. I've risked, say, 5%. I have a stop at 5%, and my average gain, let's just say, is 2 times that at 10%. So now I buy a stock, and that stock shoots up over a number of days, and let's say I'm up 15%. So now I'm up 3 times my risk, and I'm up 1.5 times my average gain. That's a time where I'm going to protect my break even almost every time. When I get a multiple of my risk, 2 to 3 times above my risk, and that is above my average gain, I generally at that point will at least move my stop up. I usually cut my stop in half, or most often I will move the stop to the break even or just slightly below the break even point. And on top of that, I might even take a little bit off the trade and try to free roll it. If I move it to break even, I may free roll it. We're going to talk about that in just a minute. So the real rule is, though, here's the rule. The rule is never let a decent sized gain turn into a loss. Once that stock, you know, when you first take a trade, it's all risk. There's nothing but risk. And of course, there's upside. There's potential upside, but you're at risk at that point. Now, the stock moves up. You've given the stock, let's call it the shot at you. You know, you put your chin out there and you've given it the shot at you. Now you're at a profit. And you're at a pretty decent gain that probably, you know, if you're at a 10 or 15% gain, that could absorb most news factors. If they come out with some, you know, some surprise news, notwithstanding something, you know, catastrophic, you know, the stock may gap down 5, 10%, even 15%. But with a 10% gain or a 15% gain, you're not likely to take a very big loss. So you're now, you know, if you want to call it, you know, working with house money, although I don't like to, you know, once the money's mine, once the stock's at a profit, I think of it as my money, so I try to protect it. But I do have I am at a gain at that point. So I'll do one of a few things. One, I'm going to move my stop up, and then I also may backstop my profit. So what that means, I simply decide, all right, well, I'm at 15% gain, and my average gain is 10%, I'll just move my stop up to 10% profit. So now at the very worst, at least I maintain my average gain. All right? So these are just a few. You could be creative with this stuff. You can come up with some of your own ways that you approach risk management and protecting your break-even point. But here's the general rules. The general rules are you start off. This is an order of priority. When you first go into the stock, the very first thing you have to you have to think in your mind is where you're gonna cut your loss. If this stock turns against me and it's a problem, where are you gonna cut the loss? My uncle point is absolute 10%, and I rarely ever want a stock to go down more than 8%. But my average is going to be something like 4 or 5%. As a matter of fact, I know Bob and I were just reviewing our numbers over the last 5 or 6 years, and in the last 5 or 6 years, my average loss is about 3.4%. So that's pretty tight. I mean, and that's getting blasted every now and then, and having a stock that's down 12 or 15% on an earnings miss, or a lot of times I'll set a stop at 7 or 8%. But I'm cutting my stocks out a lot of times at break even or at half stops once they move in my favor. So my average is much less. Once once the stock moves up, now your next priority is to protect your line. Your line is your break-even point. You want to try to conserve as much of that original starting point as you can. So now I move my stop up. Now, once the stock now makes a decent profit, now I want to go into protecting my profit. And I have to start thinking about nailing down that profit and not giving that back. So now my priority changes a third time. And at that point now I'm going to, I'm going to protect that gain, and I'm probably going to either backstop or use some other type of technique. I want to show you something that's very, very simple. And I'm just going to let, before I get into this, Dave, if you have any thoughts on that, let you talk about that.
What, on your last comments? One thing I would keep in mind. Now, this is an O'Neill rule, and since I spent so many years there, it's kind of ingrained. If you've got a stock that you bought it just right, coming out of a nice long base, the earnings are there, and the stock just takes off and goes, and you get a 25% gain in a matter of in a matter of 3 or 4 weeks. Then you should probably try to play that stock out for a much longer term, because those are usually signs of super performance stock, when it can make a big gain like that in a matter of a short period of time.
Yeah, and I'm going to talk right now, let's talk about that a little bit, on how to stay with a stock and hold it for a larger move. Now I want to give you a few, I'm going to enlighten you on a few things that I do, and I also want to just bring in a question here. How do you get stocks before they hit the IBD screens, top 50, top 200 composite? It seems that all these stocks peak when they hit the IBD list. Okay, well, first of all, in defense of the IBD list, which I don't use, however, a lot of names that are on the IBD list will be trading because they have big earnings and high momentum. We're in the very late stages of a bull market right now, and yes, you're right. At this point, a lot of stocks are probably peaking or near peaks, and you're going to see a lot of stocks, once they get that momentum, that may be the beginning of the end. However, in the beginning of a new bull market, you come off of a correction, and that's the best time to really start thinking about holding a stock. Like David just said, if a stock makes a big move in a really short period of time, coming out of, now of course that's taking into consideration that it's coming out of a consolidation. That's not after the stock's extended and it's run way up and now it's extended itself even further. This is coming out of a consolidation, like Jack in the Box did here. This is a stock that I tweeted, if some of you might have saw this a while back, and we bought some in my own account in the service. Now, let me show you how you use what we call the 50-day rule. It's very, very simple. You're buying coming out of a consolidation or VCP. You can see we've tightened up here. For those of you who know a little bit about this, you'll see there's the consolidation where we tighten up on that right side, and then here's the buy point. Now, when we come out of that base, I have a stop set. All right, at that point, I have a stop loss that usually it's anywhere between a few percent and as much as it could be as much as 8%. Hold on one second. I'm being told something here that I got. What can't they see? Yeah, okay. I'm going to put, let me just put, I'm being told that I should put a little red dot here. Okay. Can you see that? Now I got a little pointer. Has my initials on it. Okay, so here, right here is where I was buying the stock. Okay, and you can see it comes out here and then holds up for maybe a week or two, and then moves up a little bit more, has a little pullback here, and once this is the 50-day moving average. You see how the 50-day moving average comes here and catches up to my break-even point. Right here is the breakout, and that's where I'm buying it, and that's my break-even point. Now, here's the general rule. Once the 50-day catches up to your break-even point, what you can do is switch over to the 50-day. To a close below the 50-day, you can use, or there's various permutations of it you can use, but very simply, a close below the 50-day would be the easiest. And you can see that we haven't even come anywhere near the 50-day. All this time, it holds you in the stock. Now, very often what I'll do is if the stock goes up big enough and I get a really nice profit in a short period of time, I'll take a little bit off, and then I'll play a portion of it, usually half of it to 1/4 of it, for a larger move, and I might institute the 50-day rule. Now, when does this work the best? This works fantastic in the beginning of a new bull market. If you've been in a correction or a bear market, and the first wave of stocks that are market leaders start breaking out of bases, and like David said, they run up, and we can use the O'Neill rule where they're up 20% in less than 8 weeks. You should hold it. You should at least give it until the next quarter or two and institute the 50-day rule, because some of these stocks, especially in the beginning of a bull market, will go up 400-500%. Some go up 1,000% and never close below the 50-day. The 50-day contains the entire move. It happens time and time again. It generally happens with market leaders, stocks that are under significant accumulation, and every time the stock pulls back just a little bit, it's met with buying, because the institutions are looking at a much bigger picture, and that stock has a very bright future. So this is a very simple rule. Of course, again, there's lots of, we go over a lot of these things in more depth when we have more time, but today we've only got an hour and a half, so we can only do so much. Okay, so let's move on to the next rule here. And again, like I said, the first 5 rules were more on the side of return, and the next 5 rules, 5, 6, 7, 8, 9, 10, are more geared for keeping the drawdowns, protecting the drawdowns, or keeping you in a stock a little longer. And this particular rule, number 8, we're talking about selling into strength as a way of minimizing your equity your equity volatility. Now, why is this important? Well, there's a few reasons. One, if you wait until a stock breaks, it's usually you'll give up so much that you'd be better off selling even lower, selling into strength. I mean, an example of that, I don't have a chart of it right now, but I know, was it SWKS, I believe it was, had a pretty good decline today. I own that stock, and I had sold it at a fairly small medium gain. I think we were up 12 or 15%, whatever it was. Sold it as it moved up, and then it went even higher. And now, in just one day, it's come all the way back down. And you'd be surprised. Sometimes in just a few days, it not only will come back to where you could have got out very easily earlier, but it'll come in even much more. Now, the reason why the selling at the strength is important to manage your equity volatility is because as a stock gets extended and really starts to run up, and maybe it goes parabolic, and you start getting those larger days, the air pockets just get deeper and deeper, and the volatility gets bigger. Remember, we're buying from a VCP. All right, that's a volatility contraction pattern, which means that we're buying at a time where volatility is very, very minimal, and then buying in the direction, as that stock starts to turn up and move in the direction of our trade. Now, once the stock really starts to move up and get extended and get wider trading ranges, the volatility starts to increase. What does that mean? Well, it means that it's going to whip back and forth. You want to be selling it on the whip up, not waiting till it whips back down, because now you're going to be getting a lot of wide action in your underlying equity curve. So it's I think selling at the strength is really something that becomes a learned method, because the problem is that when the stock is up and it's moving up sharply, you start really falling in love. A lot of people fall in love with the name because it's getting better and better, and that's when you start to think, wow, this thing's going to the moon. And very often you'll sell these stocks into strength and they go even higher. But you have to realize the key is to just make money. You want to make money in the stock. It's not, remember, not getting the high. Now, here's another general rule of thumb that you can apply, and that is, if a stock is moved up and you're at a profit and you're pretty happy and you're thinking about selling it, but you think you're onto a monster and you don't want to give the whole thing up, you can sell half. Now, the reason why you sell half and not any other percentage, selling 30% isn't going to work. Selling 70% isn't going to work for a win-win a solution. And I'll tell you why. If you sell half, you're in a win-win psychological position. If the stock moves higher, you can say, thank God I held half. If it moves lower, you can say, thank God I sold half. Either way, you're equally right. Either way, you are right in what you did. Now, if you kept 70% of it and sold 30%, you're going to be more wrong than right on one direction, right? If it goes down, well then obviously you understand that. So selling half puts you in a win-win solution, and I do that all the time. I'll be at a profit on a stock, it runs up, and I say, I really want to get out, nail this profit down here, and I just sell half. I move my stop up to break even. If it really starts to run up, I move my stop up to my average gain, and then I just start trailing it, and I ride the other half. And then if it moves up even higher, I sell half again, because it puts me in the exact same position. You see, I'm in the win-win solution all over again. And I could just keep doing that all the way up. Sell half, sell half, sell half. And every time, regardless of what direction the stock goes in from that point forward, I'm in a win-win psychological position. Remember, trading is as much about protecting your psychology as it is about protecting your portfolio. You have to protect your confidence at all times and get yourself into a mindset to make money, not pamper your ego, and not to be a gambler and to have action. Okay. I went on a little bit of a tangent there, Dave. Why don't you let's hear your feelings on that.
Well, the one thing on selling half, I think is a good idea. When you get a stock that's very, very extended, when you've had a really nice move on it, and it looks like it's going to start forming a base, it's a good time to sell half. The one thing you want to be careful of, though, is selling the whole position of a really strong stock, because sometimes it's very hard to come back into that stock. So that's why if you can sell half of it, and then ideally if the stock, if your timing was right, you saw some distribution, and the stock starts forming a new base, well, after that base is finished, you can come back to your full position and even buy more as the stock breaks out and makes another move. But it keeps you just a little bit, it makes it, to me, it actually relaxes me in that position when I know I've taken a little bit of a profit, and I can watch a base starting to form instead of having an entire position and thinking it's going to return all the way back down to the buy point. If you take some, then you're still in that stock for what could be a much bigger move.
Yeah, and of course stocks move and the market moves in group moves. When probably if things are working in your portfolio, you're going to have multiple names that are working at that time. So when you get a lot of stocks up, this is why you can have pretty big volatility in your portfolio right after you've been doing your best. You'll be up, things are going great. Next thing you know, you go, holy cow, I can't believe am I really at this level? I was up so much just a few weeks ago. Yeah, that's because you had 5 or 8 stocks or 10 stocks that were all extended, and now they all come crashing in all at one time, and suddenly your equity's all over the place. And the key is to move up in stair steps, to make money and then go flat, or to pull back your exposure and to get ready for the next move up, and to stair step and to never really lose much. That's more important for big performance than winning. Now, I want to point another thing out, and this is because a lot of people think because I've had these giant returns, and also because I talk about the biggest winning stocks, looking at these stocks that make these big moves, that I must have these giant winning stocks. Not true at all. I actually do a lot of swing and intermediate term trading through my entire career, even when you go back to all the returns you read about and the stuff in Market Wizards. When I had those big runs, I was doing lots of trading, and I would keep small positions and play for bigger moves. But these stocks that go up, 1,000%, Qualcomm's, and back in the day where many of these names went up, a lot of people thought that's why I made those big returns. Well, I was in many of those names, but I would trade them, like Yahoo, for instance. I was in Yahoo. I was in it. It made 100% move. I was in the whole time. Well, let's put it this first. the stock made an 8,000% move. During that 8,000% move, I was in it 4 or 5 times, and I made money, I think every time, or 4 out of 5 times. At one time it was 50%, another time it was 30, one time it was 100. So when you compound it, I might have made 200 or 300% in that stock that went up 8,000%. So I got a nice little chunk that was big for me, but I didn't hold the stock for the whole big, the whole big move. You don't have to be in the stock for its entire move, but you can trade it sometimes many times as it resets. And sometimes you sell into strength, sell half, it resets, it comes out of another base, and then you add the half back. Of course, I'm getting into money management techniques, and these are things, again, that we have to go into for long periods of time with many examples. So again, if you're more interested in that, you need to come to the Master Trader program. Let's move on here. This is without a doubt the rule that has kept me or has turned me from a mediocre trader to getting stellar results, and that is to not only conduct post-analysis of my trades, but to do it on a very regular basis. You need to really, you have to know the truth about your trading. You can't stick your head in the sand, and when you're not doing well, just not look at it and try to forget about it and move on. Doing the same thing over and over, and getting bad results and then doing it again is just never going to lead to any type of real success. You have to get to the bottom of what's going on. Everybody has weaknesses. Everybody has strengths. All right, David's strengths may be different than my strengths. We may have different weaknesses, but individually, we need to know where our weaknesses are and where our strengths are. And also, you're going to find that there's commonalities in everybody who trades has certain things they do over and over that is their Achilles heel. And the reason why is because this is a very emotional game. This business is pure emotional exposure. It's like an exposed nerve all day long, and everybody has different emotional thresholds. Some individuals are very nervous and jumpy. Some are very calm. Some have no problem with with the stock market and the risk. Some are scared to death. This is going to cause you to do certain types of things and have certain foibles, and they're going to show up over and over, but you're not going to be able to mentally comprehend those in a quantitative way. The only way is to go back and to look at what you're doing. Pull the charts out, write down where you're buying and selling, and then flip through that chart book, and you're going to go, wow, look at this. I do the same thing every time. I constantly sell early. I constantly hold too long. I constantly do this. I constantly buy late. You're going to find that there's going to be 1 or 2 major commonalities that you do over and over and over, and it's going to be one of the biggest reasons why you're not where you need to be. Now, I know, Dave, I know you've done this because I learned this from you and O'Neill 30 years ago. Once I heard, O'Neill talk about this, and I happened to go to a seminar and heard David speak, many years ago, 3 decades ago, and I went right home and I broke out the charts and started writing down with a green pen and a red pen, and I realized right away I was terrible at selling. I was taking profits at the absolute wrong time. I was selling too early. I left so much money on the table. I just had all kinds of problems with selling. I was buying really well. I was placing the buy orders pretty good, and I was managing my risk pretty good, but I had no idea on how to sell. And I find that a lot of traders, they spend so much time on trying to find when to buy that when they finally get into a situation where the stock makes a nice quick move, they're scratching their head. They don't know what to do, and they don't know how to handle it. Dave, I know
Mark,
you have a lot to say on.
This, regardless of what method you use in the markets, maybe you're a value buyer, and this is you're listening to this, and you can't really relate to buying super growth stocks and things like that. But no matter what type of investing you're doing, you have to study yourself, and you have to see where you're going right, where you're going wrong, because you'll learn more about yourself by doing that than anything that we can say. I've had people call me up and say, hey, look, if I could just sit next to you for 5 days and just watch everything you do and how you're buying and what you're doing, then I could be a great trader. But to me, I can actually sit there and tell you what to do, but I don't know what's going on in your mind and when you're making your decisions, and that's really, it's kind of analyzing yourself. And that's what's so important about looking at your trades and putting them into two piles: the stocks that you made money on, the stocks you lost money on, and analyze each one of those sides, because that's where I turned around my performance. I mean, this is back in the 80s, but I had taken an account and I had doubled it, and then I lost it all back and even more. And I was so disgusted with myself, I took an entire weekend, went through every stock I had bought and sold for the prior year, and found that my big mistake was buying extended stocks. So when I cut that out and I got extremely focused on just one setup, that's when I started doing extremely well in the market. And that's something that each one of you can do, and each one you can really profit from by just analyzing yourself in your own trades. Mark, are you there?
Microphone wasn't on. Let's try that again.
Oh,
yeah. So
okay.
Anyway, I was saying that you have to have what I call your own personal epiphanies, or your own personal breakthroughs. Mental breakthroughs lead to manifesting themselves in physical breakthroughs. You have to know the truth about your trading. I can't stress this anymore. I believe in this so much that we've come up with tools that we have for our premium members. They're calculators and tools that you can put your numbers in, and then they will spit them all out and show your average gain, average loss. And I have a proprietary distribution curve, and you can analyze everything down to the most micro level and know everything about what's going on in your trading from a quantitative basis. And then from this other side, you have to, like I said, write down on the charts and try to get an idea by grading, what's going on. Give yourself a report card. You'll find out what you're doing wrong and where you're going wrong. Now, this sounds like a lot of work, but here's what you have to remember. And I wasn't profitable for 7 years. It took me, and because I didn't have the benefit of the type of education that they have nowadays, the learning curve was much longer. But I stuck with it because I knew once I got it, it would pay for itself, hands down. And then in just 1 year, I made more money than I dreamed of making in a lifetime. And from that point on, I never turned back. Once you get this and you make these breakthroughs, then it's going to be a lot easier. But it's just like anything. You can't expect to go into the market and know what you're doing and getting great results overnight. People will go to college and spend 8 years in college, but they think they can go in the market and they're supposed to be good at it overnight. It doesn't make any sense. I mean, if I went into McDonald's right now and they said, here, go make fries, I wouldn't even know how to turn the fryer later on. It's not that I'm a dummy. It's just that I don't have that knowledge. I'm ignorant to that knowledge. I would have to be taught how to make fries at McDonald's. It's a job that many people do, and it's probably not that complicated, but I just don't know it. So you really have to spend some time, and you have to get to the bottom of what you're personally doing within the confines of whatever strategy you're employing. So I'm going to give you a bunch of rules. Maybe you're going to read my book or come onto our service and learn this strategy, but now you've got to get your own personal actions to align with what needs to be done for that strategy. Now, that's going to move to the next rule. And again, these rules that we've come up with come from decades of our own personal experience and performance, and seeing thousands of traders and what they do wrong, and what the majority of traders, what their problems are, and how to fix them. And again, this is, I see so many traders start off with a style, and whether it's value strategy, they're trying O'Neill's Can Slim, Mark Minervini's SEPA, whatever the strategy is. And then the minute it's not working, they go, well, this doesn't work, and they go on to something else, and they try another style. And they're trying to find the style du jour or the holy grail, when the fact is, the only holy grail there is what I told you before, and that is managing the risk-reward relationship. That is the only holy grail, and that's applicable to any strategy. The main thing is that you become a specialist in that strategy. Whatever strategy it is, you've got to master it. And you've got to be willing to sacrifice other strategies. You're not going to be good as a day trader, a value trader, a growth guy, technical fundamentals. You're not going to be a specialist in all those things. So you have to figure out what works best for you, what makes sense to you, what you're passionate about, and then sacrifice everything else and become really good at that one thing. Now, we do have some questions here also, and I want to get to those, and I also want to just point out a few things. If you're not getting the returns that you desire, I'm a big believer of taking full responsibility for what happens in my life and in everything. At least I try to figure out how I could affect that and how I can have the ability to respond. That's all responsibility is, the ability to respond. It's not blame. If you're not getting the returns you desire, don't think that there's some special talent that's needed for this, because there's not. Because I was terrible at this for many years and was what I would call an unnatural. If there's a natural, I was an unnatural. But the one thing I was good at was taking responsibility and realizing that I had to get good and I had to learn these things myself. So I took action, I learned from that, and then I made adjustments and just kept doing that over and over. The most important thing, and this is what I didn't write books and I don't do seminars to make money. I do it because I want people to understand that they could do way more than they can imagine, and they could do way more than I can do, and to help people believe in themselves and to do great things. And that's the most important thing, is that you realize that you could do way better than I've done or David's done, because you have the benefit of our knowledge, but you have to believe in your own abilities. People fail at trading, people fail at basketball, baseball, and becoming an astronaut. Whatever it is, the only reason why they're not achieving the results that they really know that they want and they dreamed of is just simply because they don't believe in their own ability. It has nothing to do with the strategy. The strategy works. I've used it, and we have many people that have become multimillionaires from nothing with this strategy and other strategies too. This isn't the only strategy. The main thing is that you have to believe in yourself, and also if you come up with these rules, I find there's three types of people in trading. There's the first type, they don't have any rules, so it doesn't really matter. They're doomed from day one. The next group, they come up with rules, but then they fail to follow them. Either they fail to follow them all the time, or they break them every now and then. Either way, it's equally as destructive. It's just the destruction happens faster. That's the only difference. If you're breaking your rules every now and then, you're going to eventually destroy yourself in the market. And then the third group is the ones that become successful. They not only have rules, but they actually follow them, and then they work at improving them and coming up with better rules and understanding them and fine-tuning those rules as best as they can, and understand that there's nothing perfect, but this is about probabilities, okay? So with that, let's talk about some questions here. I know there's no way we're going to be able to get to the hundreds of questions, but we certainly can touch on a few that hopefully also cross-pollinate some of the other questions. And also, we're going to try to take some of these questions and submit them to be included in the questions for this new book, Momentum Masters, where we're going to answer, I believe it's like 100 questions on all different, topics of momentum trading, and that will be with myself, David Ryan, Dan Zanger, and I've personally picked Mark Ritchie II, who is somebody who came to my seminar years ago and has turned out to be a tremendous trader and has great results, and he's a new upcoming guy that I feel deserves to share his views. So us four are going to be answering questions. We'll try to include some of these questions if they're not already in the question list. We've already answered, I think, 50 or 60 questions, and we're looking to answer some more as they're submitted to us. Let's see here. So, is there a way to screen for VCP stocks? Well, you can certainly screen for a lot of parameters, but then you're going to have to do some actual physical looking at the charts to really, there's really no way around that. You're going to have to look at the charts. I know a lot of people try to come up with computer programs that have chart recognition, and that could give you kind of a broad look at it. But that real we have that specific entry point. You still need to do some eyeing. There's no computer better than your human eye. That's what I found. This is a good question for you, Dave, because you are the volume expert as far as I'm concerned. How does volume influence your buy decisions? You want to talk about that a little bit?
Yes, it's to me it's very, very important. It's a way. It's really almost the purest form to me of supply and demand. And so you want to. I study the volume very specifically, day by day, and I look to see, is it above average daily volume, is it below average daily volume, and what is the stock doing on those days. And so I watch the tracks of the volume. And really key on successful stocks. They move up on very big volume as they go through in consolidation. The volume lightens up, then they start moving higher again on bigger volume. And then the reason why I watch that is because the major moves in a stock are created by institutional buying, big money funds, banks. Those people cannot hide, and when they buy, they're not buying 100 shares or 1,000 shares. They're buying 100,000 shares, 500,000 shares, 4 million shares. So that is volume that you can actually see in the marketplace if you analyze day by day what the volume is and what is it in relation to the price move.
Yeah, and Angelo's asking, do you use any indicators or just price and volume? I really don't use any indicators. There's a few things that I look at for the general market to give me kind of an idea, overbought, oversold, but they're very dangerous to try to, not get in a market because it's too overbought or buy a market that's oversold. So I really look at price. When it comes to individual stocks, I'm looking at price, volume, earnings, margins, and sales. That's really what it comes down to. That's about all I need to know to give me an idea of whether
not on the volume. I'm just looking strictly at the volume as it trades every day in relation to its 50-day moving average. So because I just want to see it, is it bigger than average or less? But other than that, I don't look at any other indicators on volume.
Yeah, we have someone asking also about let's see, how you did. Where is it? Do you consider the trend of the overall market and your individual stock purchases? And this is Chris, I believe from Germany. This also goes hand in hand with another question. Where is it? Sorry, I got to try to find this here. Oh boy, I lost it. It was a good question that would have went good with this. Anyway, I'll paraphrase it. How do you know how do you have that longer term uptrend if the general market's coming out of a correction? Isn't that part of the trend down? So for instance, the question is, if the market has been in a bear market and then turning up out of a bear market, then the long-term trend would be down. So how are you trading with the trend? That's if I'm paraphrasing, but hopefully that's near correct. Well, first of all, when I talk about myself, I'm saying the trends all in your direction. I'm talking about the individual stock. What will usually happen, and again, this is a bigger discussion, but what usually happen is, will always happen as far as the stocks that I trade, is that the market will be in a downtrend and coming off a bear market low, but the stocks will be in an uptrend above their 200-day and breaking out of a base and usually making new highs or close to a new high. So the individual stocks are in their own earning cycle, and they're moving. That's why during a bear market, the leaders are so obvious, because the market is in a downtrend and it's coming off of its lows, and these stocks that are breaking out to new highs, and David and I often talk about Amgen and some U.S. Surgical and some of these names from the 90s, because the market was in a bear market in that in 1990 that went until October of 1990, and during that time you had all these names in the healthcare field and in technology and computers that were barely undercutting their 50-day. And then when they did, they come bouncing right back, and then they were breaking into new high ground, all-time highs and 52-week highs, as the market was coming off its lows. That was a blaring indication that these were stocks that were about to become big market leaders. Let's see. I know we have a bunch of questions, and again, I got to apologize that we're not going to be able to get to anywhere near how many are here. Is the VCP the same as a flat base? No, the VCP has contractions where it goes through. Usually, the first correction might be 20%, 25, 33%, and then it'll contract. Usually the contractions are about half of the previous correction. So maybe it contracts to 10 or 15, and then contracts to 3, 4, or 5, or 8%. With a flat base, it just goes in a real tight sideways move, and that would be there wouldn't be any contraction, but that's okay. You don't need contraction if the sideways action is really, really tight and the volume starts to dry up on the right side. So again, a little bit bigger topic that we'd have to flush out. Maybe we'll do another webinar in the future on technicals, and we'll just look at technicals and maybe even one on fundamentals. Let's see. How long do you wait to see if a trade is working before you increase the exposure? So we're talking about how, I'm not going to get aggressive until I see some traction. And a lot of people say, okay, well, how do you define traction? For me, I generally put on a few trades. If they start to work and maybe they're up 3, 4, 5% or 7 or 8%, I might put on another 1 or 2 trades. And if those also start to move up, at that point, I'll get more aggressive. So I usually try, 4 or 5, 3, 4 names. If things are really, really starting to rip and there's a lot of setups, I might move a little quicker. How about you, Dave? How do you kind of scale in?
Well, I scale in. When you read that question, I thought the individual was talking about a specific stock, and so in answering the question that way, if I have a stock, let's say the base has been formed under 30, and the stock breaks out through 30, and I start buying it at 30 1/4, and on that first day, I accumulate a 5% position, and the stock closes at 31. Well, if it follows through the next day and you get more, you got good volume on that first day, you get some good volume on the second day, I'll maybe get that stock up to a 7.5% position, buy another 2.5% position, and then on the third day maybe round off the position to a 10% position if the stock continues to follow through, shows good volume. So I want to see continued upward movement. I want to see follow through. I want to see volume. I want to see that consistent day after day of buying. That's how I start 5% and then go 2.5, 2.5, something like that. And that's where I build a nice position and I add to something that's already working.
Yeah, this is probably a good question to segue into. Adam's asking, how do you adjust your strategy in a directionless market like we're currently in? So, when we're in a market where you move up a little bit, then you move down, you're much more likely to be in a whipsaw environment. So as you pyramid right into the time when it comes in, and vice versa. It's definitely a more challenging environment, and Dave and I have had a lot of conversations about this. We're getting later and later stage, and it looks like the market is under some distribution here. Maybe a correction's upon us. You just simply have to adjust your risk accordingly, and if things are working, then you're going to stick with it. But if they're not, you're going to scale back, and you may have to wait. I think it was 19. I got in for the bull market of 91 in late 1990, going to 91. Got very aggressive, traded really aggressive from late 93 until April of 94. I don't think I made a single trade. So I waited over a year in cash. And during that time, market went up a little bit more. It wasn't horrible, but then we had a correction going in 94. So there's been times where I've waited out of the market for extended periods of time. Dave, what do you think? With this particular environment, and how do you handle that when you're just sort of moving back and forth?
Well, this is where I actually look for more stocks and buy on pullbacks and not as much on breakouts, because what you're dealing with, and even what's happened today, is you get stocks that have had these doubles and triples and quadruples over the last couple of years, and then they're forming these small bases. They're breaking out into new highs off of small bases, and then they reverse. Sometimes they can reverse and reverse very badly, and very, very hard reversals like we had today. So the way I treat a market like this is more look for stocks that are the primary trend is up, the longer term trend is up, and I'm looking for pullbacks within that upward trend. Now, I'm not buying it as the stock continues to pull back. I wait for that pullback to hold, maybe get some volume and start turning and start going back higher. You might look for trend lines, stocks pulling back down to trend lines, stocks moving back down towards 50-day moving averages or 20-day moving averages, and looking for those types of stocks that are in really good, strong uptrends. And the last thing is you have to look at the volume. Is the stock pulling back on huge volume, or is it pulling back on lighter volume? If I get that combination and the stock holds, starts moving higher, that's where I'll buy on a pullback. But I tend to buy more stocks on pullbacks in a market that whips around like we're experienced, because breakouts in this market, not that many actually work and continue to move strongly.
Yeah, they're not following through much. So now, of course, on pullbacks, like we said before, Dave's not going to buy if this on the way down as the stock's crashing in on huge volume. A light pullback, it's coming in, it's pulling back maybe to the breakout, pulling back to the 50-day for the first time, and then starts to turn up. That's where he's going to be going in there. So we're not just buying on just pullbacks, but this is another another area that we get into in extensive for hours and hours and hours at the Master Trader program, which we only hold once a year. But I want to answer Juan, who's asking, do you offer, and this gives me a chance to give a shameless plug of the Master Trader program, do you offer an online mentoring program for people who live overseas? Well, we have tons of people that are around the world that are on the daily platform and that come to the Master Trader program. To my surprise, we've had over 60 countries last year, from India. They come from everywhere. It's really amazing. Every year I see people, and I'm amazed that and humbled that someone would some people fly 44 hours the total trip, 26 hours from Beijing, and these big trips to come and see David and I and talk about these things. And we make sure that you leave knowing A to Z everything that we're talking about. Okay, like I said, we have an hour and a half here, and we can't get into it in too detail. But at the Master Trader program, we spend 2 days. It's I don't know, 16 or 20 hours of of going over this stuff. So that's where, if you really want to get into this deeper. Yeah.
Yeah, and Mark, I would add, you mentioned, we lay all this stuff down. So then it's your responsibility. It's your job then to take all that material and then put it to work and start doing it yourself, and then studying your mistakes and studying your winners. And that's I mean, it's a great head start for somebody who's just getting into trading, or even somebody who's been around for a while, to go over these things again. But it's, as you said, it's all laid out there for them to then work on it as they get back and start trading on their own.
Yeah, and with that, we've been going now for an hour and 45 minutes. We're 15 minutes over our hour and a half scheduled time, so we're going to have to wrap it up. However, let me just tell you this: we have hundreds of questions here. We're going to, and many of them are overlapping. A lot of you are asking similar questions. We're going to submit these, and you're probably going to find that the majority of your questions here are going to be answered in this book that's coming up, Momentum Masters. And it's not even going to be answered just by David and I, but they'll also be answered by Dan Zanger, who's an extremely capable trader. He's turned, I guess it was $11,000 into $40 million in just a few years. That's a pretty hefty return. And Mark Ritchie, the second, who is Mark Ritchie Senior, his father, who was in Market Wizards also. His son is Mark Ritchie II, who's turned out to be a really great trader and a wonderful person that I'm very fond of, and is also going to be answering those questions. So you'll have the four of us answering all these questions in a roundtable type format, which I very rarely have seen in the book, where you'll be able to contrast and compare and see how we all answer the questions. So I think it's a pretty neat format, and it'll be very educational. And so look for that. And we'll try to do, we'll do another webinar down the road here. We try to do them when my time permits, and we'll maybe get into more specific, like some technicals or something, or we can key in on some of these questions with more specifics. But I want to thank you guys for coming today. It was fun. It's always fun for me. I'm always learning, even when I'm teaching, and I know David feels the same way. And we'll see you soon. And I know a lot of you follow me on Twitter, so see you there too. Okay. Take care, everyone. Bye bye.
Great. Bye bye.